If you bought your long-term care insurance 15, 20, even 30 years ago, especially from Genworth, back then GE Financial, you might be getting a rate hike letter. You might have already got your insurance premium rate hike. You'll be paying more for your long-term care insurance. Now, what do? I was reading an article in Barron's. It says they bought insurance for security and old age. They got a financial nightmare instead. It is never fun to have extra costs coming in, especially when you thought that here's this insurance that's going to help me out in my old age. Well, guess what? You bought it 10 or 20 years ago. You're 10 or 20 years older. We're getting closer to the old age. All of us are. So what do you do when you get that rate hike letter? Let me tell you a little bit about why the hikes in premiums are going on, and that might give you some insight on what you might want to be doing with the extra cost in long-term care insurance premiums these days. Now, there's 3 reasons why the costs for long-term care insurance are going up and why you'll probably get that long-term care rate hike letter if you haven't yet already. First one is that way more people are actually holding on to their long-term care insurance than the insurance companies expected. Insurance companies price in figuring, a few percentage of the people that buy this will not actually go ahead and keep their long-term care insurance. So they would have, as an insurance company, keep that money for quite some time, but not have to pay it out if you were someone that canceled out. Well, virtually everyone is holding on to their long-term care insurance. And so that means more people are needing the actual insurance to pay out, and the claims are going on at a higher rate as well too. So people are holding on to their insurance policies. They're using more of it later on. And also, when the insurance company took your money early, they invested it expecting to get some interest for later on when they paid you out. Well, that interest, especially from 2008 to 2023, was much lower than expected. So you look at the insurance company that based their premium, what they told you was going to cost, on more people canceling it, high interest rates, and less people actually making use of it, and all the opposite things are happening. That's an encouragement for you to actually hold on to the policy yourself. The fact that the costs are going up is just a symbol that more people are actually using the insurance later on. That's an encouragement to do what you can to keep this insurance policy. Of course, there are 3 different things you can do when you get that rate hike letter. One of them is just to accept the increase. The company like Genworth or whomever is sending out the increase to you says, well, for your set level of actual costs or actual coverage, the costs are going up. Talk to your financial advisor and see if you can cover that cost. It's absolutely not fun to have a higher bill, but thankfully, up until this point, you had the lower insurance cost, the insurance cost that was actually too low. And we know it's too low because you look at a place like Genworth, especially looking at an article here, it says that they are hoping to get to break even in 2026. They're losing money. So even with these increases in premiums, Genworth is losing money. They're hoping to break even. And that's kind of a goal for your insurance company with long-term care insurance. You want to have them around down the road. And if you like having the coverage, it's a tough pill to swallow, but you may want to accept that increase and pay the higher cost to keep that level of coverage that you sign up for. You could also adjust your coverage. Say, here's a certain level of premium you're willing to pay, and let's just bring our coverage down to match that. That's a way to consider it, because then you keep your premiums the same. And yes, unfortunately, you have less coverage than you signed up for, but you still do have the coverage. Another thing you could do is often, now every single situation might be different, but look at that letter. They might allow you to cancel the policy, and then every dollar that you've put into it up until that point, if you put in $4,000 a year for 15 years, then it's like they hold on that $60,000 in that example for you in reserve, and that down the road, you can make a claim against that and the $60,000. They won't refund you for all the money that you put in, but it's as if they'll hold on kind of a pot of money for you. You don't have to pay going forward, but you could claim against that $60,000 that you've held over time. This long-term care insurance is it's a sad situation that you bought the insurance to help you out later on down the road, the insurance companies are needing to increase the rates, which is my encouragement for anyone who's buying a new long-term care insurance policy, is I would encourage you to go with a mutual type of policy. I see, and these are not recommendations, but I see mutual type of policies like Mutual of Omaha, Northwestern Mutual, Thrivent Financial, which is a fraternal benefit society. Those are ones I've come across. There may be more, and I'm not recommending any of those in particular, but I like the idea when you're buying long-term care insurance to find a mutual insurance company. A mutual insurance company means that everyone who's a policyholder is all in it together. And so if you buy the long-term care insurance policy and the premiums were actually too high, the company will figure it out, start issuing dividends back into the policy or to you to reduce the cost of the insurance. They're not there as a mutual insurance company to pay out dividends to stockholders. They're there to take care of their policyholders. At the same time, too, if they unfortunately underpriced and you paid a too low of a premium, and that mutual insurance company is going to raise the rates on you, as a mutual company, they're not trying to raise the rates to break even plus a little bit more so they can take out some dividends to the stockholders. They're trying to raise the rates just to keep you whole, keep the insurance company whole. When I look at things like that, they just need to make sure they're around. And so if and when they increase rates as a mutual insurance company, I found that those rate increases aren't nearly as much as what a stock insurance company might be, because that stock insurance company has to be around to pay you and has to be around to pay dividends to the shareholders. So I'm curious, what are you doing with your long-term care insurance when you get these rates? I see really all three. I've seen people take the increase, just I want to keep the same insurance, but I'm going to pay the higher cost. I've seen people keep that cost the same, but adjust down their coverage. I've also seen people cancel their coverage just because they couldn't afford the premiums going forward, or they just didn't want to keep on paying for that. So put in the comments, I'm curious, what are you doing with your long-term care insurance when you get that price increase for your premium? Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.